So why do CFOs care about sales tax? Why should they? Well, sometimes they shouldn't. If you are a growing technology company in the Valley, then let me guess, you're trying to develop product, get scale, get customers, and trying to ramp up. You're probably not thinking about compliance issues, much less sales and use taxes. When CFOs do or should start thinking about sales taxes in the technology sector is when they do have the scale and they're starting to double their revenue every year and they're approaching a liquidity event, whether it's a sale of the company or filing of an S1. That's when they need to start thinking about sales and use tax exposures. So if the CFO is not thinking about sales and use taxes and they are an inflection point company that's approaching a liquidity event, frequently that will be brought to their attention, usually one of three ways. The auditors will bring it up, or two, an M&A due diligence team comes in and says, you're not collecting anywhere, we want to escrow $2 million for uncollected sales taxes. Or three, the audit committee says, I've got two other companies and this has been an issue, have you, CFO, looked at this? So usually if you're approaching that event, then you need to at least know what the number is. And that's what's key. Even if you don't want to take the time and don't think the time is right now to totally clean it up, you at least don't want the surprise. You want to know what the number is. So let's run the numbers. So to run the numbers and at least get an idea of what your exposure is, it's the identify and quantify part of identify, quantify, resolve. You may choose to resolve it or not, but at least identify and quantify. The identify consists of two things. Where does the company have nexus or duty to collect tax? And where is the company's product or service taxable? Nexus simply means that the company has a sufficient physical presence in the state where the state can force them or obligate them to collect sales use taxes in that state. The second part of identify is the tax base. Where is your offering taxable? It's kind of similar to downloaded software 15 years ago when on-premise software went from CD-ROMs and tangible media to a download. It took a while for the states to catch up to that. But the twist now is now you have these different business models that aren't just software. Maybe it's EFSS, Enterprise File Sync and Sharing, which is file collaboration software that lays on top of storage. So there's a lot of complexity and it's analysis that needs to be done in each of the states. So once you've identified where the company has a duty to collect, or nexus, and you know the states, or pretty confident you know the states where the company's offering is taxable, the quantifying is easy. All you need is 3 or 4 years of sales numbers by state, and you crunch it into a matrix that gives you tax, interest, and penalty by state, and then gives you the big ugly number in the bottom right-hand corner of that spreadsheet. So frequently when I meet with a CFO, because I'll email them the spreadsheet and said, this is for discussion purposes only, and I quickly get an email back saying, this number is outrageous, it's shocking to see that number. But that's usually not the real number for their exposure because the customer either, especially for large enterprise customers, they've self-assessed it, or they've been audited by the state, or they have a direct pay permit, or they're an exempt entity, or some other reason that they're not taxable, or that the tax has already been paid. And there's an effort to go through to collect that information from the customer. It's pretty simple to do, but it's a little cumbersome, but it's okay. The number is not going to be the number in the bottom right hand of that spreadsheet. So once you've identified and quantified the potential exposure, you want resolution. And when you get to resolution, you want to focus on the states with the most liability. In the states with the largest liability, you can enter into an agreement with a state called a voluntary disclosure, or VDA, where they limit the look-back period, 3 or 4 years, and most importantly, get a penalty waiver. And the last part of resolution is communications, and that's internal communications and external communications. So there are communications that need to be prepared to prepare the customers for the fact that you're going to start collecting tax, and for the internal team to understand when this is happening and why. I work with a lot of CFOs in the cloud space here in Silicon Valley, Austin, Atlanta, all the technology centers. If you'd like to have a conversation or at least quantify the exposure, give me a call.